Good morning, everybody, and welcome to today's webinar, Simple Steps for Starting Your Business. It's number 5. So some housekeeping rules. This webinar is being recorded and the presentation will be emailed. If you have any question, please type it in the chat and we will answer all those questions at the end of the presentations. Okay, simple steps for starting your business. So this is session number 5, funding options. So today's presenters are Tom Sims as an host, myself, Mike Moore, and Bob Garcia. Okay. So homework review. So like every workshop we do, we have some homeworks. For the workshop was on financial projections. So we had, given a template with the workshop that we had sent to you all. So there was this template. If you have if you've been working on it, that's great. If you haven't, then maybe you want to start working on the financial projection for your business. And so let's see next one. Okay, so the agenda for today is, so we're going to be talking about funding and sources. What are the credits or the 6 C's of credit, what bankers want, and borrowing strategies, and then going or not, making decisions on your business, go or no go decisions on your business. Okay, let's go number 6. Okay, so why do businesses need funding? Okay, so there are many reasons for the businesses to look for seek for funding. So it could be, we can see that there are like different outcome that business is looking to do with the money. So to grow business or drive sales, maybe it's a new location that it's, they're trying to open, or maybe it's a new product they're trying to launch, or they're trying to increase digital marketing. Okay, the second reason could be increasing production or service capabilities. So that could be done by, adding more equipments or making it automated, upgrading technology or softwares, or maybe they need more funding to train their additional, maybe they need more staff, right? They need more people to work. So they're going to be doing a lot of trainings. And they're gonna maybe have a replacement for their vehicles that they've been using, so maybe it's costing them a lot of repair and maintenance, and they wanna, buy a new van. And the next reason the bank or the businesses looking for money is to boost profits. They wanna shift their sales from in-person to commerce. Take advantages of volume purchase discounts to lower costs. So when you buy a lot from the suppliers, then maybe you need, maybe you get more discounts. So that's what they want to take advantage of that. And increase staff productivities. Maybe they're giving some incentives to their employees. Maybe they're offering health insurance, or maybe they're offering different type of incentives to boost productivity for their staff. And manage cash engaged in the business. So maybe they have, they're trying to consolidate their debts. Maybe they have a lot of different credit cards, and it's hard to keep track. Maybe they're paying a lot of high interest rates on those, and they want to put it in one, one package. They want to build inventory for busy seasons. Maybe it's Christmas time, and maybe it's, like a Halloween time, or whatever business they're trying to, increase their inventory. So they need more funding, and they have, so handle seasonal cash requirements, or they want to secure funds for unexpected, expenses that could, come up in their business. So they're trying to become, prepared. They want to be prepared. So those are some of the reasons that the bank, the business is looking for funding. So let's go to the next slide, please. Okay, so this is a survey questionnaire, business outcomes. So what are the business outcomes you're seeking and the action you can take to reach them? So this maybe can help you decide what you're trying to do, the funding that you're looking for. Are you, opening a new business? Are you, trying to, buy another business? So grow your business. And this is like, do you have funds, like available, like from your personal fundings to, take care of that, whatever outcome that you want from your business. If you're trying to increase production or service capabilities or boost profits or manage cash engaged in the business. So these are some of the things that you can, just answer these questions for your business, which can help you why you're needing fund and what you're going to be doing with that money, right? Let's go to the next slide. Okay, so this is like, if you like, when you determine this is how much you need, and now what are the sources for your funding, and what are the advantage and disadvantages, for those type of sources. So we can look some the sources of funds. You can have like a business cash reserves, and the pros are the advantages that it's inexpensive, and you have low risk source of funds, right? You have flexibility to use profits and retain control of your business. Remember, this is your money that you've been saving, right? Your cash reserve for your business. Maybe you were, very smart, being very smart, you were saving 3 to 6 months, fundings for your emergency stuff, right? So the cons are accumulating, of course, when you're, accumulating reserves, it can take longer. And you can limit your cash availabilities for emergencies or other needs. So the second option, or the borrowing option, is equity investment by owner. So this is a primary source for startup early stage businesses. This is what you have to put from your pocket. That's your money, So when you have your saving, it's quick access to funds, right? It's your money you can use right away. You don't have to go in the processing. And then the cons are, it's going to require additional cash from owners. Of course, this is your money, so you have limited money to use for your personal financial, stress. So that's what it means, that you have this money saved for your business. So you're not able to, you don't want to use for your personal financials. And the third option is equity investment from external sources. So this is, the pros are no repayment schedule, potential industry experience and connections from investors. So what that means, when you have, investors that they are gonna, being like a stockholder or your shareholder for your company. So that means that they are experienced, and they can also help you with your business to grow, right? Because they have interest in your business now. And the cons are, you may lose your profit, future profit and control of your company, because now they're also the owner of your company, right? And they also are looking for higher interest or the higher returns. So then they're gonna take initiative in your company's growth and trying to, have some control of the progress of your company. And the borrowing, that's the next funding option. You could, often, this is outside financing. This is the lenders, outside lenders, or the institutions like bankers. You're trying to get loans. Excuse me. So this is often lowest cost form of outside financing. And you could, because you're borrowing money, you're not having anybody to take care of your, take control of your business. So you retain total control of your business. And equity and profits, those are all yours, because it's the money that you're borrowing. You're not adding any owners to your company. Okay, so the cons are, you may not be available. The sources may not be available for new business, or those without sufficient equity. So that means the loans that you're trying to qualify, if you don't have enough sales or net profit in your running business, then maybe it's hard to get those loans. Or they're looking for collaterals, So if you don't have collateral, maybe it's not possible to, get any kind of grants. or funding for your loans. And your business personal assets at risk if not repaid. So that's, again, that's talking about collateral. So if you don't pay the loans on time, or if you're not paying at all, then your personal assets could be at risk. Okay, so from here, I would ask Tom Sims to take care of this session. And thank you so much for your time.
Thank you so much, Jaspreet. We have to make the decision for ourselves which is best for your business. How much cash reserves do you have? What plans do you have to use these funds? Are you reinvesting your profits in the business? And does your current cash flow meet your needs? What plans have you had in place already, and are you making to secure more equity? Who is going to provide that equity? Is it you or an investor? And how much debt do you have now? Do you have plans to borrow more? So ask yourself these questions very seriously and be ready to answer them for yourself, honestly. You need to select the right kind of financing, and that depends on your own particular needs and position in the business. It could be a business credit card, which is great for everyday purchases, rewards, based on your spending habits, and it's short-term borrowing. You want to pay it back quickly. The other thing is you access your funds up to the credit limit of the card, and it may be available for transfers of balances. The payments work. You pay a minimum, but you never get ahead, so you want to pay more than a minimum. The interest rates are high. The collateral is usually not an issue, and you want to check on these things. I'm just not going to go over check every time, because do you have it or do you need it? That's what you're going to put down there. Then there's the business loan. That's major purchases or one-time cash needs. It typically funds at one time after your loan closing. It's all there. You put it in the bank, it goes in the bank. You pay a balance over time. It's amortized over a term. The interest rates are locked. What you see is what you get. It can be secured or it may not be secured. It just depends on the loan you negotiate. You could have a business line of credit, and that's for recurring or seasonal cash flow needs. And that's money that's available to borrow, not up to the limit necessarily, but for something. You may have to borrow some money for Christmas, or the farmers borrow it for planting season. You access it by drawing on your credit limit. You have a method that's set up with your lender. The lender may offer various terms, including once a year. It just depends on the nature of the loan. Interest is typically variable. We call that floating, and it can be secured or unsecured. The other funding sources that I'm just going to mention, family and friends, online lenders, fintech, which is the funding for, it's really specialized. Let me just say that. You can talk with your mentor about that. There's peer-to-peer, there's crowdfunding. I'm going to come back to in just a moment. Department of Agriculture and Rural Development has some loans available depending on the state. And then the Department of Community and Economic Development, CDIF or CDFIs are very popular for securing SBA loans. And I think they'll be addressed in a few moments, and we can coach you through that. Equity investors, who Jaspreet has already mentioned. They own a part of your equity or some of your profits, however that is negotiated. Crowdfunding is one we're not spending a lot of time on here. We have several mentors that have had experience in helping themselves and helping other people set up crowdfunding campaigns. It's important to strategize this, to determine what you're offering to the public for their usually non-equity investment in your business, and what the best platform for what you're doing really is. Other funding sources, we talk about family and friends. It can be easier to get these. It may be lower interest rates. it can add strain to family relationships. It can change the conversation at the holiday table, or sometimes eliminate the holiday table altogether. Your equity investors provide funds in exchange for ownership. They want to get something out of this. There are typically no payments. They get paid either from profits or the proceeds from any ownership sale, or if it's a corporation, from the same way other investors and shareholders get it. Some investors are experienced business owners, and they may provide you practical advice, and they may offer some real help. And finding the right investor can be a long, involved process. It's not as easy as 1 hour on the Shark Tank. The CDFIs are nonprofit community development financial institutions. They typically serve community businesses, small businesses, micro enterprises, in some cases nonprofits, commercial real estate. They finance businesses that spark job growth and employee retention in hard to serve markets. They're tailored for smaller and early stage businesses. In other words, and in fact, it may be your only first option if you don't have 2 years track record. There are online lenders. There are ways to get a little bit of money up front. They're fast decisions, sometimes within minutes, sometimes within days, predictable monthly payments. They have more lenient credit terms. They're higher interest rates. They're going to get something for their easiness, and they may be difficult to find for large amounts. Peer-to-peer lending sites like one of the ones that you know most is Kiva, or the Sharks have set them up. All the Sharks seem to have one of those businesses now, but borrowers with lower credit ratings may qualify. They may offer lower interest rates than other options, fast application process, no interaction between the lender and borrower. Typically, this landscape is changing a little bit. It's mostly used for personal loans, but today there is a new thing on the horizon where businesses are doing this. They may require substantial personal information for eligibility. This is not easy money. You want to really think through this strategy. I already talked about crowdfunding. Crowdfunding enables you to use social media, and if you have a very large social media platform, it may be the way to really get some money, and it's not going to be like hundreds of thousands of dollars, but it could be enough to start what you're doing. And then we've already talked about fintech. It's companies that use advanced technology to improve financial decision-making. Encompasses a wide range of financial services, from mobile payment to online lenders. Sometimes it's easier to get. It offers various financial opportunities. We're very fond of SBA guaranteed loans that come through banks. Sometimes the CDFI is the best way to secure these. It's a percentage of the loan that is guaranteed by the Small Business Administration. They don't actually give the loan, they guarantee the loan. Banks are more willing to take a risk on your business with them. Department of Community and Economic Development, we've already talked about local economic development programs, and then Department of Agriculture and Rural Development Services. If you're located in a rural area or starting an ag-based business, there may be a special loan available to you. The SBA also has some of these loans. And so what you want to do is just make a note, use this sheet when you get it to make a note of what's up for you, what's going to be the best route for you. And I'd like to turn it over to my retired banker colleague, Bob Garcia.
Thanks, Tom. For new businesses, and as Tom said, that's usually for businesses that are 2 years or younger, or for startup businesses, if you're in need of financing, often you'll become affiliated with SBA guaranteed loans. You can go to this website, sba.gov, and it will talk you through the various loan programs offered by the SBA, and includes disaster financing and federal contracting. For government grants, I find this website very interesting, very informative. You can go to this website and it will show you what grants are available. and the application process for them. So it's very informative and has a lot of information that may allow you to qualify for government grants to finance your business. Next slide, please. Financing from the balance sheet, usually we're talking about a line of credit. Tom touched on this. Bank lines of credit, accounts receivable, financing, and or factoring. They are lines of credit, and you either have a revolving line of credit or a non-revolving line of credit. Up till now, we've been talking about consumer loans, that term loans, I mean, and they have a maturity of 12 months or more and are paid from the cash flow of the business. Lines of credit are paid not from cash flow, but from an event happening within the business cycle, and they expire, and they usually expire 12 months or within the business cycle. Equipment leasing, oftentimes this is a lower monthly payment. There are two types of equipment leasing for businesses, usually a capital lease or an operating lease. You need to know the difference between the two because they affect your balance sheet and your income statement. The capital and at the end of the lease, one makes it less expensive to purchase the asset if in fact that's what you want to do. Chattel mortgages is a type of financing. It finances what banks call rolling stock. We're often talking about large pieces of equipment that are movable. Plant improvement loans, usually you're talking about equipment that's going to improve the plant, and conditional sales contracts is a type of financing where title does not transfer until the loan is paid off. All of these things you should consider when you're looking at financing from the for your business that'll affect the balance sheet. Next slide. Next slide, Tom, please. Let's try slide 18. Thank you. What lenders are looking for. Obviously, they're looking for good credit, management experience. If you're a cook and you want to open up a restaurant, as a lender, I'm looking for more than just a good cook. I'm looking for somebody who has experience in managing the restaurant. If you're making up a business plan, the business plan, what is reasonable and feasible? How does it compare with the industry? And we measure that with industry standards. And in previous sessions, we talked about RMI, which gives the different ratios and standards of various industries. We will measure that with the business that you're trying to open up. Adequate owner's equity. You need to have some skin in the game, as we like to call it. What is your equity injection? Nobody will finance you 100%. And sufficient collateral. I'll talk more about that in a minute, but you don't necessarily, especially with SBA financing, you don't necessarily have to have collateral, but it certainly helps assure up your application for financing. Next slide. The 6 C's of credit. This is one of the foundations of lending. It was around when I started my banking career many, many years ago. Character, capacity, collateral, capital, conditions, and cash flow. All of these are considered when an underwriter is looking to approve your loan. Let's start with character. Next slide. So how do you determine character? Trustworthiness, personal business credit history, integrity, references, experience in the business, and the impression on your lender or investor. Obviously, to look at somebody and determine the character is not something we're able to do. So they look at the business and personal credit history. Your credit report is the reflection of your character for any loan application. It needs to be good. It needs to be up to date. It needs to show that you've paid your bills. Next slide. Capacity. Is your company able to repay the borrowed amount? How soon can you generate a positive cash flow? When will you show a profit? How large will the profit be? And more importantly, can the profit be sustained? The SCORE financial projection template is an excellent tool to use when trying to determine if in fact your company can make it financially. And it will help you determine where your break even is, help you determine when you will have a positive cash flow to pay your bills. And if done correctly, it'll help you with your go or no-go decision. Next slide. The capital, the money you personally invested, again, you need to have some money invested in the business when you start it, and then you need to save it into your capital account for your equity. The capital account or your equity account tells your investor or your banker the strength of your business. The stronger your company is, the better it will be able to handle a downturn in your industry and or the economy. Very important. Next slide. The conditions, the terms of a loan, oftentimes the intended purpose of the loan will determine the length of time you will have to pay it back. Within the banking industry, a working capital loan is 3 to 5 years. If it's SBA supported, you will have up to 7 years to pay that loan back. Equipment, 5 to 7 years. With SBA support, 10 years. And with SBA support, you can get up to 25 years for real estate financing. How much is requested and the length of the loan? Never ever go to your banker or investor and say, how much can I borrow? You go to your banker or your investor, you tell them, I need X amount of dollars. This is what it's going to be for. This is how I'm going to pay it back. You also need to be aware of the climate of your industry and of your business. All underwriters now for conventional financing have to make a comment on how the recent pandemic is affecting your industry in general and how it will affect your business in particular. You need to be able to relate that to your banker when you apply for a loan. Next slide. Additional forms of security. Let me talk bank jargon here. Any loan application that an underwriter makes starts out with the primary source of repayment will be the cash flow of the business, or in the case of a startup, the projected cash flow of the business. The secondary source of repayment is the liquidation of collateral, whether it's secured by the loan or whether you hold it personally. Liquidation of assets is the secondary source of repayment. Third-party guarantees can be in the form of guarantees, usually from parents or relatives, can be in the form of an SBA guarantee. The state of California has an SBA program, which we can talk more about during the question and answer period. These are things that help strengthen the loan, but please recognize just because you have a guarantee from the federal government or the state government or for mom and dad, it will not take the place of a poor application. Tangible assets held as collateral, property, equipment, accounts receivable, inventory. Oftentimes, if you're financing an asset, that asset will be securing the loan, but you're not given a dollar for dollar. If you finance in a piece of property, you're given 80 cents on the dollar. For example, if you get a $100,000 loan secured by a piece of property that's worth $100,000, in the loan, it'll only be given a value of $80,000, so it will only be partially secured. They leave a cushion in there for changes in market value, and also that cushion will help pay for any cost incurred if the loan goes bad. For equipment, you usually get 50 cents on the dollar. Accounts receivable and inventory, you usually get 10 cents on the dollar. Next slide. Cash flow. Please recognize cash flow is what pays the bills, not profits. Profits are part of cash flow. Cash flow includes all sources of cash, whether borrowed or invested. Where's the money coming from? Where will it go? How much of a cushion should I keep? The cushion is determined by the industry you're in. Cash and carry businesses don't need as large a cushion as a business-to-business type company where credit is extended to other businesses. Know your industry and know what you should keep within, how much cash you should keep within your business. Next slide. And the credit score and report. So FICO score of 700 or greater is desirable. Yes, it's greater. I will say from personal experience, your credit score is not doesn't have to be as high as a consumer loan. It's not as strict, I guess, is what I'm trying to say. But it has to be current. And you need to recognize that if you've ever defaulted on a federal loan, and I'm speaking primarily of college loans that you defaulted on, you won't get financing from the SBA. If you're behind on your taxes, you won't get financing from the SBA because it's a federal organization. Know your credit report. You can get it from the annualcreditreport.com. You should keep that up to date and know what your FICO score is. But keeping your credit up is as important as it's ever been. And I'm going to turn this over to Mike. Thank you, Mike.
Good morning. Let's talk about what bankers want. I'm a retired banker and I've spent lots of time reviewing packages, and I have a pretty good idea of what we're talking about here. Without getting too specific, the banker wants enough information to be able to make a reasonable, solid decision that he can then sell up the chain, he or she, I should say, up the chain, because the friendly loan officer you're talking to doesn't usually have the authority to sign off on these things and make a commitment in behalf of the bank. It has to be approved internally. So a letter of an introduction is very helpful to give a good description of what the business is, who you are, what the purpose of the loan is, and where it's going to go from here. That ties right into the summary of your financial needs. If your business is up and running, they're going to want to see at least 3 years of financial statements, and those should be at least done on QuickBooks or some other computerized program that foots balances every year and demonstrates profitability. Tax returns, of course, those are done on a cash basis, but they too should reflect the profitability of the business. There may be a difference between the financial statements that you have and the actual tax, excuse me, tax returns. That's okay, as long as it can be reasonably explained. We'll want to see a cash flow statement going out for at least 1 year. And as Bob just mentioned, this is where loans actually get paid. So this is why it's very important to the bank to be able to see what sort of cash flows are coming into the business. Second part is what collateral is going to be available. Again, as Bob mentioned, there are many different classes of collateral. There will be the business assets, but there may be outside assets. There may be guarantees. You'll want to identify those going in. Personal financial statements and tax returns are also going to be critical, because banks are held to a high degree of due diligence. Remember, banks are federally regulated, or at least state regulated businesses, and they need to demonstrate to their examiners that they're doing a good job of making sure that the loans that they make, which is the public funds, are well supported. So they look at the business and they look at the individuals themselves that are behind the business. Lastly, a resume is very helpful, because you want to be able to describe that, or describe the fact that you have the experience they need, or that they need to see. You have the experience to make this business work. They will also ask you a few other questions, like, are there any legal claims against you? And you've got to be very clear on that. Are there, or are there not? Are any assets pledged? What that means is, have you already borrowed money using some of the assets that you have? They'll need to see that, because that eliminates those assets from being useful in terms of supporting the loan that you're talking about. This last one, or this next one, is pretty obvious. Of course, you want to make sure that your tax returns and payments are up to date. You should just do that as a matter of course. You want to know if you have life insurance. If something happens to you, is there going to be cash made available to help wind up the affairs of the business, or buy out buy out your position for a new buyer? And finally, they're going to know, how is your monthly household income and expenses? This is a pretty squishy number, but it has to be reasonable. The thing they're looking for is, are you desperately in need of money to get by? That could be a problem. Next slide, please. So comes the day you're going to meet the banker. You're going to need to know what we call your SWOT analysis: your strengths, your weaknesses, the opportunities that you see, and the threats to your business. Sometimes these are hard to think about, particularly threats, because that's a negative area. You feel, well, why should I bring up all these negative things? Shouldn't the bank figure that out for themselves? Better for you to lead with it, but show how you are addressing that threat. In other words, think not threat, but risk. What are the risks in your business, and how are you protecting yourself against them? It can be in your financial structure. It can be in the way that you do business, any number of things. Strengths is pretty obvious. Weaknesses, again, you don't want to leave it for the bank to figure out. You want to lead with them. That's right up there with risk. You want to talk about, these are the risks in my business, and here's how I'm addressing it. Down here at the bottom, they talk about using the strengths for your elevator speech and your abbreviated presentation. That's only natural. Lead with the positive. Tell them how great this business is going to be, but be ready to answer the other questions. The borrowing process, let's take this step by step. First of all, you decide that you need a loan. Generally, that's a pretty obvious decision. The application, I want to point out, this is not a financial statement that you produce. You're going to produce a personal financial statement, usually on the bank's form. Your business financial statements, of course, are generated by you internally, but they'll all be part of the application process. Next, it will go to underwriting. These are the people that typically you don't meet. They're in the background. They get all the information from the loan officer that you're talking about and make a decision based on the information that they obtain. Now, I think I might treat these two over here a little bit differently. Processing, if you get an approval and it's a subject to approval, it may be subject to an appraisal, for instance, on the real estate that you're going to use, or an examination of your accounts receivable. They want their own auditor to come in and have a look at it and give an opinion. Usually then the final decision is made. Closing is pretty obvious. They've produced a bunch of loan documents. They want you to sign them so they can give you the money. Great. When you are at that point, when your loan officer has loan documents, you sit down with them and say, okay, I'd like you to explain these to me. You have that right, and you should know what's contained in there. Sometimes there's things that people don't expect. You want to know what they are. And the final step is the repayment of the loan. If you signed up for a line of credit and it's for seasonal needs, you're going to want to make sure that once you receive in the cash, that this amount of credit allowed you to produce assets to sell to obtain, that it comes in. And you want to make sure, if it's a straight loan that's amortizing over time, make sure you keep your payments current. Next slide, please. So again, and really a lot of this is common sense, preparing for your next financing. And people say, well, why am I doing that? Well, as Bob mentioned, lines of credit, for example, are typically 1 year at a time. That doesn't mean the bank wants to throw you out every year. They want to have a relationship with you. But every year is an annual review, typically, of the financial progress of the business, your financial progress, how it all worked out. It's very important. Minimum is that you made your payments on time, but that is not the only element that's going to go into this final decision. You're going to want to talk about business issues or deficits that come up. The important thing is to build this track record. We're selling, we're successful, we're making money, we're keeping money, we're building equity in the business. These are things you want to be able to tell your banker for that annual review. And so you end up with a strong balance sheet and make it easy for the banker to say yes for another year's term. Next slide, please. Okay, I'm not going to talk about all these, but let's talk about, because we've already kind of talked about them already. Borrowing requests should be meaningful to the sort of business that you're running or the purpose of the loan. Let's go on down. Lenders focus on the 6 considerations when assessing a loan request. The 6 C's of credit, they're all there all over again. They want to make sure that those 6 C's are still intact. Understanding the borrowing process and setting the right expectations leads to a good experience. You always want your banker to have a good experience with your company. You want them to be able to talk you up as one of their best loans ever made. And so putting all this in writing can help you and the lender understand the fundamentals. Next slide, please. Before you talk to the banker, it's going to be important for you to go over a checklist similar to what you're seeing here. And you need to be honest with yourself, because you need to identify those areas that you need to shore up before you talk to the banker. My product is servicing an unmet need. Great, you're bringing a new product in that does things that nobody else does. That's fantastic. Next part would be my product service could be expanded to gain additional customer groups. Okay, we've got a chart for growth here. I know who my potential buyers are. That's critical. your demographics. Who's going to buy this product based on income levels, locations, all the ways that you can slice and dice the market, as specific as you can be about who that buyer is going to be. And you have a clear value proposition. There's got to be a reason that you're going to do this. And you need to be able to demonstrate it in terms of, we're going to take this money, we're going to do this, people are going to buy it, and there's the money. You know what it will take to start the business. That means everything: legal organization, additional employees, sources of supply, because your banker's going to ask about that. They want to make sure that you've got all these bases covered. And you know what it'll take to run your business. Well, that's pretty self-evident. Understand what it will take to obtain funding, so that when you talk to them, you're talking about something reasonable, not pie in the sky. It's like people come to us and want, well, my business is worth this, and I want to get a loan on this property over here, and I want a 100% loan to value. Well, no, that's not going to work. You got to understand what your limitations are there. And you have a plan to fund the business that kind of goes hand in hand. I'm ready to work hard to achieve my business. Is there anybody who says I'm not really willing to work on my business? I don't think so. And be focused on the challenges ahead, i.e., not only the opportunities, but the risk ahead and how you're going to deal with them. Next slide, please. Next slide, please. Okay, at this point, I'm going to turn it back over to Tom, who's going to do the wrap up of our session. Thank you very much.
Thank you, Mike. My fingers weren't very fast. This is where we've been. We have completed all the sessions: startup basics, business concept, marketing plan, financial matters, funding options, and congratulations, you've come the length with us. You have completed simple steps for starting your new business. If you came in the middle, or you came in late, or maybe this is your first session, don't worry, we're going to be running this a number of times through the year, and you'll be able to catch up. We invite you to go to the Starting Your Business Student webpage and download the surveys, the worksheets that are there for you, and the manual that goes with this process. We wish you the best. Let's say you've scored 100% on that last assessment and you're ready to go to the bank. If you don't have a mentor yet, get one of us, request one of us, because we'd like to go over it with you and help you improve your chances of success in getting your business funded. Or maybe you haven't started your business plan. We really want to help you. We want to help you further your research on your idea, complete or polish your feasibility plan, finance or finalize your financial forecast, develop your plan out so that it's professional, help you as you work through preparing your loan package and you launch your business and grow your business. At SCORE, we say we're here for the life of your business. Now, we want to graduate you that have submitted all the paperwork and your names. There are 3 of you that have submitted everything, and we're going to now recognize you. Now, while we're recognizing these folks, this is your chance to type your questions for our panel of experts. And after our formal graduation, we're going to answer your questions. Take as much time to do that as necessary. I'd like to have us look at the diplomas that we've prepared, because you have sent us the requests. And Asuncion Duarte, are you in the room? We'd love to, we want to give you a hand of applause. So we congratulate you and your Valley House Cleaning Service, LLC, for graduating in this process. Who's our next graduate? Reina Uribe, congratulations to you for completing the SCORE Entrepreneurial Training Program Series. We wish you the very best of success. And we had one more that submitted everything, and that's Angel Viscara with Viscara Transport, LLC. We know that you are going to be making America work by transporting goods and from one place to another. You keep the process going. We thank you so much, all of you. And those of you, if you didn't submit the paperwork, we still congratulate you for completing the process. We would be honored, and we would be actually gratified.
We still have time if they'll send in their name and business today to Christina. We will prepare those and send those to you today.
Okay, by end of business. All right. We would love to get those to you, but do it today. And now we request that you fill out this online survey. We're going to send you the link to that, and that will help us to continue to improve this. Now, in the chat box, Christina has put the email to get your attention, to get her attention, so that by the end of the day, you can get your certificate in the process. But we need that information today. So we have a panel of experts here ready to answer questions. And the first question is, what is the link for the presentation workshops? Well, we've got really good news for you. That we're going to email that link to you. And we're going to actually email the worksheets for today. Okay. The first question, I'm going to go to Robert Garcia, who talked about the 6 C's for credit. Robert, Bob, does a banker want to make business loans? What is the mood of the bank in terms of making good business loans?
Yeah, believe it or not, they do want to make loans. They want to make loans. That is their business. They want a relationship with businesses because it's profitable for their company and their bank. When you make your application, you need to give that banker every opportunity to say yes. If you're well prepared, you will get a yes for you. But I will say, especially for startup businesses, don't be discouraged if you're turned down once or twice. I know many people who have applied several times to various lenders and finally got that yes they were looking for. So and take a look at non-bank lenders, CDFIs. There's a state of California guarantee program also, other than the SBA, which is handled by an outfit called Valley Small Business. I know my old company, SynCal Business Finance Group, has several loan programs outside the SBA 504 loan program. So there are other sources available. Speak to your mentor. They will tell you who they are and where to go.
Thank you. Mike.
I'd like to just add a little something there, in the 6 C's that Bob was talking about. But it's important to keep in mind, while we say this is what you need to do as an applicant, on the banking side, we're also looking at those same 6 C's. And one of the things that's different on the other side of the banking desk is conditions. While it's good to be aware of your local area, the likely market, all these sort of things, and those are conditions that a borrower has to do. From the banking standpoint, there's one more, and that is, what conditions are we going to put on this person? Which is why I say, when you get your loan documents, you sit down and you read them and you make sure that the loan officer explains them to you. There'll be conditions like, we'll only lend you X amount on your receivables. And if it falls below this, we're going to lower the rate. Or if it goes above this, we're going to do something else. Or if you are not managing your receivables, for example, and they start to get slow, we're going to cut those out of the equation altogether. There's things that you got to be aware of, and that's why you need to make the loan officer explain it all to you, because those conditions are usually, they should be negotiated up front, but a lot of times I found borrowers are only finding out about them at the end when they're sitting there in the office. But you can't agree to things that are going to hamstring you and what you want to do.
Right. Mike's absolutely right. In the 27 years I was with SynCal making SBA loans, there was, I could count on one hand the number of people who actually came in, sat down with me, and went over that multi-page loan agreement, wanting to know every line item and how it affected their business. You need to know what you're signing on for.
Thank you to both of you bankers. You answered the next question I was going to ask you. So I won't ask it. Here's a great question. We're learning about what entrepreneurs must have to get loans. My question: someone without any personal investments, family assets, and first generation person with a dream, ability to discipline, to build and operate a business, what else can he do to get money to build his business? I'm going to start with Jess Preet, who has lived this. And Jess Preet, will you answer that? And then I want to pass it on to the others.
Yes, thank you, Tom. So I believe if I want to start any business, what I'm going to do, I'm going to start saving, So what that means, I'm going to start budgeting myself, my personal expenses. So whatever income I'm making, maybe I should keep 5% of that income. And that's just like just accumulating that income for like maybe 6 months or 1 year or something. Because when you want to become a business person, it does not happen overnight. You need to give time to yourself to collect the funding. And the best source of funding is your personal saving, So I would say that it's all happening from your self-discipline, whatever you're saving, it's for you, for your business. So then you look for, if you are able to show this is how much I have, like I have 25,000 and I only need 25,000. And then the banks or the lenders, they will seriously listen to you because now you have your personal funding, that it's your personal risk. So they're willing to take risk when you have something to show that you have a, investment. Okay. And I
Thank
think
you so much. Would either of you guys add to that?
Yeah, I would like to add to that. And, what Jaspreet has defined here is absolutely correct. You need to start saving. You need to be focused. You need to be disciplined. You need to be setting aside this money. It's going to take time. This is not going to be a open the door and here's the money sort of thing. But at the same time that you're accumulating these funds, you need to hone in on what business is it that you want to be in. And you need to look at the news stories about businesses in that business. You need to look at what are the associations of business owners that do that sort of business. You need to start developing contacts. There's a whole lot you need to do to build up to the point where you can say, okay, I'm ready to do this. I know how to do it. I've got the contacts. I've got these people. I've got this money. Because that's a whole lot more than just saying, I want some money. You got to be there.
Bob, can you use the word bootstrapping in a sentence? Because I think we have a webinar coming up on that, and it's going to answer some of that question.
Well, bootstrapping is obviously trying to accumulate what you need from a variety of sources in order to start your business. Too often, I think, and especially with the recession of 2007, 8, 9, and then the pandemic, people try to start a business because there's nothing else, that they can't get a job or something. And that's the wrong reason for going into business. It may be a last resort, but they're usually unprepared. You need to be prepared. I can't express this strongly enough. I think Jaspreet and Mike said it best. You need to be ready to start this business. And part of that readiness is having your equity injection.
Your mentor might be able to help you discover some creative solutions for starting small, for putting your feet in the water and learning your business and building it up before you are looking at funding a bold initiative. Or it may be that there's some steps that you need to take along the way. Question, and in the first few words, the word magic appears, but I love that word. Is there a magic number or formula a person can do without, my thing is moving, without the investment up front? Well, that's the thing I was just talking about is no. Would anybody say there is a magic number for anything in this business?
No, but I do think that where the magic can happen is, and kind of building on what I said earlier, is once you start moving within the industry, once you start making the contacts, you're also at the same time looking for people to join you. in this business, because if you want to get anywhere, bringing somebody else's expertise into it and experience is going to add a lot to your ultimate success. You want to bring them in, maybe as an investor or simply as an advisor, but you've got to build that. That's where the magic can happen.
That's where the magic happens. The magic will start today, by the way. If you don't have a mentor, requesting one. That's where you're going to start getting it going. What's next? Let's get this train rolling. Angel, you're right. That's where you do it. Put in, it's score.org/find dash, is it a dash again? Anyway, Christine will put it in both in your email and in your chat box. There it is, score.org/find-mentor. And that's where the magic starts. And that's where a lot of the resources happen. And that's where you get to express your ideas. That's where you find the magic. Are there any other questions coming along? We've covered the big ones. So it's Monday morning, and you and Mike or Rob said no. Don't give up on Tuesday. You just regroup and go back. Peter, do you have any observations for us?
We're right in the middle of tax season. It's probably on the mind of everybody out there. Some of you that are starting a business, we have a great webinar tomorrow with a tax advisor on finding the right accountant for your business. We'd love to have you come in there. Every business is a little different, and come on in there, and we will go through the nuances of how to find an accountant for your business. And more importantly, he will be one of your better advisors as you go forward. On next week, on the 8th, we have Good Morning Central Valley, and that's for all business owners on here. And we have a senior banker from one of our banks here on banking relationships for those that are starting a business. And then we have another tax advisor that's going to talk about the taxes for 2022 and the obstacles that you're facing today. And then we have another one, HR person is going to talk about onboarding employees in 2023. And very good stuff, but more importantly, it is put on for you that you can ask questions about your business and get those answered. So tomorrow we'll be finding the right accountant, and then on 8th will be Good Morning Central Valley, and hopefully we can answer a lot of your questions that you didn't get answered today, or you may have more questions later on today. So please join us. It'll be a fun experience for everybody, and get a lot of your questions answered. Thank you, Tom.
Thank you, Peter. Please bookmark centralvalley.score.org and go there about once every couple of weeks and check and see if there's a webinar coming up that's going to meet your needs. And sign up for our newsletter, because we'll keep you informed. I think that's going to wrap it up. I don't see any more questions. We really appreciate your participation. You keep us on our toes. Thank you, Bob and Mike and Jaspreet, for your expert advice. I think that the investment that you've made in our friends is going to pay off for all of us. So we wish you goodbye for now, and we look forward to seeing you either in the mentoring section or in our next webinar.